if you're closing on a property, if you're going to sell a property near the end of the year, try to push the closing date over into January. What's that going to do? That is going to defer your capital gains to January, which then gives you 11, 12 months to figure out how to absorb those capital gains, depreciation, or whatever it's going to be, how you deductions, how you can take those deductions over the next 12 months. If you take capital gains in December, you've only got a couple of days to absorb those capital gains unless you were properly planning your property deductions throughout the year. So deferring income is one way to lower your tax basis for the year. And that one's a little counterintuitive because most people don't think of that. So I'm putting it out there for you to think about it. If you have a closing on a property, if you're selling a property for sure, if you've got it under agreement now, see if you can push it until the beginning of next year to offset the capital gains that you're going to need to pay. Hey, what's up, all of my real estate peeps? This is Brian Lucier with another episode of the Why Not Real Estate Podcast Golden Nugget, where we will take a tip, tactic, or technique and unpack it and explain it to you so you can use it in your tool belt to be a more successful entrepreneur, real estate investor, landlord, professional. So today I want to unpack pre-tax savings. So it's not the end of the year yet. So that means there's still time to make a difference on what you're going to pay for taxes. Tax planning is all year round. You don't wait until January 1st and then say, okay, what happened last year and where can I do the deductions? You should systematically be looking at every month of the year to best utilize how you can take your deductions. Well, right off the top, if you are a real estate investor and you have purchased a rental property, the value of that property divided by 27.5 is your annual depreciation. So that's baked in. So just being a real estate investor, you should be taking your depreciation off of your properties. Of course, there's the interest that you pay on the mortgage as well. So that's a double dip of ice cream there. But I want to talk about some tips that you can implement now that will move the needle on what you have to pay taxes. So there's only two ways to affect this number. You can have these expenses paid before December 31st, whatever they're going to be. We'll talk about some ideas in a second. So you can either pay expenses before the end of the year in this tax year to save on savings, or, and this one may not be that popular, but defer income until next year. So let's talk about that one first. Deferring the income, right? So how can you do that? If I'm a contractor or if I'm billing for services, maybe I can work with some of my clients and say, look, we're going to bill you in November, but I don't want you to pay it until January. Okay, they'll be happy unless they see this video. They'll be happy because they don't have to spend the money until next year. I'm going to be happy because I don't have to declare it as income as next year. So you're saying, well, okay, I'm not a contractor, but how can I do that, right? So one way to do it, if you're closing on a property, if you're going to sell a property near the end of the year, try to push the closing date over into January. What's that going to do? That is going to defer your capital gains to January, which then gives you 11, 12 months to figure out how to absorb those capital gains as expenses and depreciation or whatever it's going to be, deductions, how you can take those deductions over the next 12 months. If you take capital gains in December, you've only got a couple of days to absorb those capital gains unless you were properly planning your property deductions throughout the year. So deferring income is one way to lower your tax basis for the year. And that one's a little counterintuitive because most people don't think of that. So I'm putting it out there for you to think about it. If you have a closing on a property, if you're selling a property for sure, if you've got it under agreement now, see if you can push it until the beginning of next year to offset the capital gains that you're going to need to pay. Now, the other one, more intuitive, is having expenses. If you have an expense as a business, it is deducted as an expense cost first off of your taxable income. So if you have taxable income of $1,000 and you have expenses of $500, the expenses will be deducted from your income. So your taxable income will be after expenses. In our example, $1,000 of income minus $500 of expenses, you're only going to have a taxable income of the remainder of $500. So there's a lot of ways we can do this. One way to do this is to prepay bills for the next year. You can do this at the end of the year. Maybe a good idea mid-December is to start paying subscriptions. If you have like Better Pockets subscription or whatever it might be, a Google account or any other account or web domain hosting or anything like that, anything that's an annual expense that you pay, call them up or email them and say, hey, can I prepay in advance in December? You may get a discount, but you'll definitely get the full deduction. So legal services, retainers for attorneys, contractors, if you've got ongoing projects happening, move the expense as their income before the end of the year so you can take the deduction. A really, really good one to think about is advertising, right? We usually do this. We send out Christmas cards to all of our clients and tenants. Not sure if we're going to hit that mark this year, but it goes out as advertising. You can send out a Christmas card or some other type of thing like this, or actually do advertising. You can do pay-per-click. You can pay people to do SEO optimization on your website or your social media. You can do mailers, mailing campaigns. Anything that you do to promote your business before the end of the year can be advertising. You want to have a really fun one? Throw a open social party for all your clients to come to as a Christmas gala for the end of the year. That whole event, if you do it right, could be deductible. And boy, does it go a long way through the rest of the year to secure services. Now, let's look at your properties. You always have maintenance at properties. So are there deferred maintenance items before the winter you want to take care of? Obviously, if you're watching our podcast, you know from a couple episodes ago, winterizing your properties. There's things you can do that will be an expense before the end of the year that will actually save you money into the winter season. Pre-purchasing salt, a skid of salt, shovels, buckets. If you've got a lot of properties, it makes sense. You could spend $700-800 on a skid of salt, some extra shovels, and do all this before the end of the year. Your tenants are going to love it because they see you as being proactive before the ice, or having ice melt on site, or shovels on site, or taking care of their families. And on the other side of the scale, you've taken some serious deductions that you can offset to your income. Remember our example of $1,000 income, $500 expenses, only taxable on the remainder, right? So remember that. And again, repairs, it's always a good idea to do these. Deferred maintenance costs more money down the road. So if you've had a really good year and you're looking at some income, then good idea to spend some of that before the end of the year. Another thing that you can do, we talked about prepaying contracts. You're going to have a plow contract, or you're going to have someone plowing your property. Say, hey, look, I know it's going to be 50, 60, 70 bucks every time it snows that you're going to come out and plow. Can I do 10 payments in advance? Can I do $1,000 in advance to have as a retainer for you to come out and do my snow plowing? Hopefully, they'll say yes. I mean, I don't know why they wouldn't, but also the other side of that, because you prepaid, they may give you preferential treatment during a snowstorm and go on out and take care of your properties first. And then again, on your bottom line, you've got more expenses to offset your income. Now, no heat calls, that's going to happen too. You could do that with plumbers. You could do it with electricians. Anyone who you're constantly doing business with that you're going to end up paying anyways. If you do have a surplus of income before the end of the year, see if you can work out a deal with them to give them some type of retainer or some type of prepayment for future invoices that you can deduct before the end of the year. Now, let's look inside your home. If you're a real estate investor, you either have a real office or you have a home office that's proportioned out in your home where you do business. Well, Black Friday's coming. What a great time to update a computer or a printer or a desk or office furniture or bookcases or storage or books or training materials or that course that you always wanted to take. You always invest in yourself when you invest in your education. I love books, and I'm constantly looking for new sources to educate myself to be smarter. Hopefully, submitting to this podcast will be smarter for you. But hey, guess what? This is free. So let's look at your home office. You need a phone line. So a portion of that expense for your phone can be deductible. The service, your internet connection, your cable service, if you need to be on Zoom or whatever, your computers, your desks, your chairs, your monitors, anything having to do with you doing business can be purchased and again becomes 100% deducted expense to your income. Okay, everyone's responsible for how they do their own taxes. So again, I'm not giving you tax advice or not advising you to do anything that would not be in tax code. Always run this by your CPA or a legal tax preparer to make sure you're within the guidelines. For me, a home office, no more than 20% of your mortgage or rent or utility bills or cable bill. 20% is a safe number with the IRS, but again, consult with a CPA. And then, of course, now you upgrade, you are running better, more efficiently. I mean, who doesn't love having a new computer and working on that? But again, your phones, if you update your phones, upgrade your phones, upgrade your office equipment, upgrade your office furniture. These are all things that you can do. And if you're buying the books and it's legitimate for training, you can deduct those. And now you got to store them somewhere. So might be worth it going to IKEA. And of course, if you're driving a long way, you can deduct your mileage to pick up what you need for office furniture. One last thing I want to talk about, and this is more in time with the season. One other expense that you can do are bonuses to your employees or your contractors or anywhere that you can write a check and show appreciation for someone. That really shows a lot of goodwill because everyone's scrambling now at the end of the year. Heating bills are coming in, things are going to get more expensive. People extend their credit cards for the holidays. And it's just a lot of goodwill. I mean, I know I'm planning on doing something here. I'm not going to put it on this podcast because I don't want any spoiler alerts. So let's talk about one last thing. I know your eyes are rolling saying, oh, I can't afford a new computer now, and the time's just not right, and I'm going to have to wait until my taxes come back next year. Well, let's think about this for a second. I always like to use this example of a computer. a $2,000 computer. I ask people all the time when they're thinking of starting a business, I ask them, how much does a $2,000 computer cost? And they look at me and say, a $2,000 computer cost $2,000. And I ask them, does it really? If you're going to buy that just straight out, like Brian's going to buy a computer, where do I get that money? Well, from my paycheck. So I work and earn $2,000 and then I go buy a computer? No, I work and earn $2,000 and then state and federal tax comes out and I'm maybe left with $1,300. So I have to earn a lot more money and pay taxes on the money I earn to be able to go out and buy a $2,000 computer. Well, if I'm looking at state and federal tax with no other deductions at 45%, I have to earn $2,900, pay taxes, to have $2,000 left over to buy a $2,000 computer. So I've almost had to earn $3,000 to buy a $2,000 computer. And I'm sure they're just going to give me that $2,000 computer at $2,000. No, I'm going to have to pay sales tax unless I go up to New Hampshire or work it out and buy it in the state where there is no sales tax. In Massachusetts, it's 0.0625. So that $2,000 computer is going to cost me $2,125 with the sales tax. So I'm already spending an extra $1,025 on a $2,000 computer. My $2,000 computer is going to cost me $3,025. Why would I do that? Especially if I'm in business. So let's look at it the other way around. Okay, I still have to earn the money to buy the computer. Okay, so I have to earn the $2,900. I still have to pay the sales tax. Okay, but now my full deduction is going to be $2,125 off of the $2,900 that I had to earn. So I'm going to just do the quick math here. 2,900 minus 2,125. Now my taxable income is only $775. So that computer is 100% write-off. Of course I can do that. That's legal. And I take that 2,125 that I paid for the computer and I use that as 100% deduction off of my taxable income of 2,900 that I've already paid tax on anyways. And I'm only paying tax on $775. So why would you not do that? But it gets better. That's not just your computer. That's your computer that you use for business, your phone that you use for business, your car and mileage that you use for business, your desks, your software, your subscriptions, everything that we just talked about for expenses all gets bundled up into a big fat expense number. And if you do it before December 31st, then it is a huge tax deduction. You get to take pre-tax dollars. You get to deduct that right off the top of what you earned. And then you're only paying taxes on what was left. So hopefully, if you had a great year or however you can do it, if you can manage to get out and prepay some expenses or defer some income until January, then this is my gift to you for the season. Hopefully it's worth thousands of dollars in your pocket that you're not paying for taxes this year. And remember this throughout the year. Starting January 1st is your tax season for the next year. So try to plan out every year what you're doing throughout the year and don't try to cram it all into the last week of the month. Okay, there it is. There's my golden nugget for pre-tax savings. I hope you found this useful. Definitely utilize it in your business. I don't care if it's real estate or you're an electrician or a plumber or whoever you are, if you're a business owner watching this, you have a business niche that this can apply to you. So I hope this helps you out. Put it in your tool belt to become a more successful entrepreneur, business owner, property owner, landlord, real estate investor. Thank you all again. This is Brian Lucier with another golden nugget, signing off to all of my real estate peeps and rock stars, wishing you all the best, and we'll see you on the next one.